Before we begin, please support the channel by subscribing, liking, and sharing this video. Constructive discussion is always welcome, and we invite you to share your views and insights in the comments. Market liquidity shifts, index rule changes, and tech earnings analysis for May 27, 2026. This video presents a direct informational narration of the source document. All right, let's take a quick look at today's agenda. We're breaking this down into 6 key areas based on the latest market data. We'll be covering macro and liquidity shifts, market structure and squeezes, fast-track index inclusion, space and software equities, medical tech and earnings, and we'll wrap up with tech earnings and the broader outlook. Let's dive right in. Starting off with Section 1, Macro and Liquidity Shifts. So first up, there's a U.S. brokered preliminary 60-day ceasefire draft currently on the table, and it's already having a pretty immediate cascading effect on global commodity pricing. WTI crude futures actually dropped by nearly 5%, officially losing that crucial $90 mark, and broad commodities are feeling that same downward pressure, with spot silver falling 3% to head right back to the $75 level. Alongside all of this, 10-year Treasury yields are continuing to fall. Ultimately, these easing inflation and energy price expectations are stepping in to relieve some of the valuation pressure that had been weighing heavily on tech stocks. But here's the catch. That pullback in commodities hasn't exactly translated into capital flowing smoothly back into equities. Instead, the market structure remains highly fractured. You can vividly see the structural volatility playing out in the crypto space. Over 90,000 accounts face liquidations totaling a massive $347 million. And that all happened within just a single 24-hour window. Zooming out to the broader indices, we've got the S&P 500 just sort of oscillating around that 7,500-point level. Goldman Sachs's fund flow team just put out a very precise warning on this. Top book liquidity has contracted severely, shrinking down to just $9.445 million. To put that into perspective, that's a 24% drop from the year-to-date average, which puts current liquidity in merely the 33rd percentile over a one-year look-back period. To make that liquidity crunch even more interesting, we have the upcoming end-of-May pension fund rebalancing to consider. The data projects a net equity sell demand somewhere between $14 billion and $20 billion. Now, while that absolute number isn't historically massive on its own, think about the context. When you drop that kind of sell demand into a market that is already suffering from diminished liquidity, incredibly crowded institutional positioning, and impending mega IPOs, it acts as a very real catalyst. It could absolutely trigger severe short-term volatility or even a broader technical pullback. Moving right along to Section 2, Market Structure and Squeezes. We're seeing some very clear market imbalances right now. Goldman's assessment is highlighting a really stark structural imbalance in the current market. On one side of the equation, you have AI hardware and space sectors. These are now firmly categorized as crowded momentum trades, offering pretty low risk-reward profiles. But on the flip side, defensive sectors like healthcare and utilities are experiencing extreme short interest. In fact, short interest in the healthcare sector just surged to a 30-year high, and utilities and consumer staples are also hovering near historical peaks. This exact setup creates the prime structural conditions for a potential short squeeze in those heavily shorted, lagging sectors. Which brings us to Section 3, Fast Track Index Inclusion. We are looking at some structural rule amendments that are about to seriously impact the broader market. The FTSE Russell has announced a major rule amendment. Newly listed companies that meet the market cap threshold for the top 500 U.S. indices can now bypass standard quarterly reviews entirely and gain fast-track index entry just 5 days post-IPO. This builds right on top of the Nasdaq's existing 15-day fast-track rule, and right now the S&P and Dow are actively evaluating similar amendments. Ostensibly, this is designed to reflect major market changes more swiftly, but realistically, it acts as a direct high-speed pathway for the upcoming mega unicorns scheduled for mid-June. So what's the actual structural consequence of these fast-track inclusions? Well, it's massive. Trillions of dollars in passive ETFs and index funds will be subjected to forced, mechanistic buying of these newly listed mega unicorns at historical highs, well before the market actually has a chance to establish rational price discovery. As a direct result, this creates passive selling pressure and weight dilution on legacy tech companies, these so-called old giants. This dynamic is widely expected to spark unprecedented volatility across the major indices. All right, pivoting to Section 4, Space and Software Equities. Let's look at some individual names. In the broader space sector, there are currently unconfirmed rumors circulating regarding a potential 2027 integration between Tesla and SpaceX. It's definitely sparking speculative discussions, though institutional capital is remaining quite cautious given how far out that timeline is. Elsewhere in the space, DXYZ announced a massive $1 billion share dilution plan. That is a staggering number when you consider their total market cap is only $1.17 billion. Over in software, VRRM experienced an absolutely catastrophic single-day collapse of 70.5%. This happened after they drastically cut full-year revenue guidance and lost their core client, Avis Budget. And finally, in e-commerce, PDD saw a notable drop following a rare miss on both their revenue and profit expectations. Over in cybersecurity, Zscaler, ticker ZS, actually reported a Q3 beat across its key metrics. However, the stock dropped heavily right after because they issued weak Q4 revenue guidance and reported slowing new customer additions. It perfectly highlights Wall Street's incredibly strict punishment for any disruption in forward-looking growth narratives right now. Conversely, SMTC reported a Q1 revenue beat of $291 million, which was up 16% year over year. But because the stock had already surged 113% year to date, it faced almost immediate profit taking the second the news hit the wire.
Section 5. Medical Tech and Earnings. Medical technology giant Boston Scientific saw its stock drop by exactly 12.5%, touching a 52-week low and actually leading the declines in the S&P 500 for the day. This sharp decline followed a critical industry conference update from the company's CEO regarding their core products. During that conference, the CEO laid out specific structural headwinds step by step. Step 1. Demand for their historically high-growth Watchman product is slowing down, and they're now expecting flat revenue for Q2 and Q3. Step 2. Their electrophysiology business is actively losing market share amid some really fierce price and channel competition. And Step 3, which was the most impactful. As a direct result of all this, Boston Scientific was forced to slash its 2026 organic sales growth guidance from a previously projected 10.5 to 11.5%, all the way down to a range of 6.5 to 8%. That effectively shattered the high-growth illusion for institutional investors, triggering immediate liquidations.
And finally, Section 6, Tech Earnings and Outlook. Let's look at the latest institutional reports.
We've got a few notable institutional tech earnings to cover here. Marvel reported Q1 revenue of $2.4 billion, which is a 28% year-over-year increase, and they're expecting Q2 revenue to jump 35%. Snowflake reported $390 million in revenue, up 33%. Now, a really crucial point of clarification on the data here. Snowflake is committing a $6 billion investment into Amazon Web Services over the next 5 years for AI computing, not the other way around. Lastly, ServiceNow reported $1.1 billion in revenue, up 13%, with earnings per share surging 50% to $3.88, alongside some really strong free cash flow. To wrap things up with the market outlook, overall market liquidity is demonstrably shrinking, and capital is becoming hyper-concentrated in the AI, hardware, and space sectors. The broader market is essentially being starved of rotational liquidity. Over the immediate term, especially with that impending pension fund rebalancing we talked about, the structural data suggests closely watching the S&P 500 as it tests the 5-day moving average support zone right between 7481 and 7470. So, with capital so hyper-concentrated in AI and space, the big question remains: will this starved rotational liquidity be the catalyst for a broader market pullback, or is it just a temporary hurdle? Keep a really close eye on that 7470 support level. Thanks for joining us for this explainer.